Hi, I'm Hubert Centers. Welcome to Absolute Wealth's weekly edition of Centers Strategies. Let's take a look at this week's strategy. In this week's strategy, let's talk about how do you trade crazy. And I don't mean mentally crazy, but how do you trade a market that's a little bit off its rocker and just not that stable with all the global economic news releases that are coming out of Europe. So usually the stock market is driven by either news or price action or patterns or technicals. Right now it's really being driven by lack of credit. So one thing you can always do is you can go over to Bloomberg, check out the headlines, see if you see any good stuff or any bad stuff, and figure out if you can trade something around that. Now, I don't recommend you just trade off of the news. I recommend that you look at the technicals, and if you have a trading pattern that's setting up, then you can use the news as a filter mechanism. So first thing here, obviously there's U.S. stocks rise on consumer confidence surprises. You also have U.S. home prices decline more than forecasted expected. So you got, a little bit of a plus there and then a little bit of a minus. Then you come over to CNBC and you can see that Bill Gross is saying 5% is the best you'll get in years. And then you can also see crisis in Europe tightens credit across the globe. So there's a lot of cross currents that you have to navigate. So here's a really easy way to trade crazy. So the first market we're going to take a look at is the S&P, just because it's the biggest, thickest index out there, and it's a good barometer for what's happening in the world. So the first thing that you should notice is there was a massive gap on this past Monday, and it was a pro gap. And a pro gap just means, all a pro gap means is it's gapped up and it continued higher. So that's a good thing. Now, they're hard to trade unless you're already in them. Now, if you look back and you just look at just good old common sense, you can go 1, 2, 3, 4, 5, 6, 7. So this is the magic number 7. If you have a market that goes up 7 days in a row or down 7 days in a row, you tend to get a little brush fire, or in other words, it's like dry kindling, and you strike a match and just boosh, it's combustible. So that's what you've got with here. You had a little bit of news in Europe saying that they think they've got it figured out, which I don't think they've got it figured out yet, but whatever. So any exaggerated sell-off to the downside, it is normal and natural to have some short covering or some dry tinder, and then you strike a match, there's a spark, and then poof, it goes higher. So what is the natural retracement, and where's it probably going to go? Super simple. All you're going to do is you're going to grab a Fibonacci tool. You're going to grab from the most recent high, and you're going to drag it all the way back to the most recent low. A normal retracement, if something sells off hard or rallies hard, it's going to pull halfway back. Just remember, halfway back. We call this an ambush trade because it's natural for the market to retrace back to this area of 12,206 to 12,220. So in this area. So if you're not short the indexes, which they look like they're going to go a little bit lower as far as the past 7 to 10 days go, this would be a good area to get short if you're not already short with a tight stop. Now, if you're not in the short camp, you can do the exact opposite trade of this, and you can use the bonds, and you can get long bonds at 142 and 23 30 seconds or 142 and 2 30 seconds with a stop right here in this area of 141 and 24 30 seconds and a target of 145 and 17 30 seconds. Same exact trade applies to what's happening in gold. We're going to take a Fibonacci from the most recent high to the most recent low, and gold is probably going to retrace into the 1731 area all the way up to 1747. So you can go ahead and get long gold. If you think it's going to go higher, that would be a target. I think it's going lower, so I'm waiting for it to get back up here in order to short it again to roll over with a target of 1665. We also talked about last week being short crude oil, and now it popping back down below. So anytime that we get another consolidation or congestion area here on crude, if it breaks above 98.65, that's a long, and if it breaks below 94.94, that is a short. Now I'm in this intraday / overnight trade a little bit earlier just because I was trading crude last night and I got a fill at 97.70 I have one contract that's the lowest number of contracts that you can trade on crude. It can't go any smaller. And you can see that in the last night's trading, I lost about $200, but currently I'm up $15.40 as it's going higher, and I'll just do auto center, and now you can see it's trading at 94.24. So on this trade setup, I have a 10-tick stop loss, and I have an open target, and I'm looking for the target to be around, 101 to 102-ish. If it goes to 101, I'll definitely take it, but I'm just entering it a little bit early, and was just intraday and overnight scalping it, and the trade just busted loose. So we're holding it with a 10-tick stop and an open target of around 101. So remember, when you're trading a market that's crazy or lost its mind, and you've had a sell-off or a run-up, use a Fibonacci retracement and let it come halfway back, so then you can mess with that area of concern. Good luck, hope it helps. I'll see you next.